What if I told you that a violent crash to $15 silver could actually be the loudest buy signal of this entire decade? What if the same move that made people panic, sell, and swear off metals forever is the exact move that historically precedes explosive upside? And what if the institutions you've been told are too big to fail are quietly the most exposed players in this entire mess? Because here's the uncomfortable truth most people don't want to hear. Markets don't collapse when everyone is confident. They collapse when the system is stretched, leveraged, and pretending nothing's wrong. And silver right now is flashing signals that are impossible to ignore. Picture this. One moment, silver is bleeding red, smashing through levels that should never break. Headlines scream crash, social media fills with fear, and weak hands capitulate. Then, almost violently, silver flips green. Not slowly, not politely, but aggressively, as if something behind the scenes just snapped. That's not random. That's not retail traders. And that's definitely not normal price action. This video isn't about hype. It's not about fear-mongering. And it's definitely not about predicting exact prices. It's about understanding the mechanics behind what's happening, why banks are far more exposed than they admit, and why silver's volatility right now may actually be a warning shot for the entire financial system. By the end of this video, you'll understand three critical things. First, why a crash to $15 doesn't mean silver is dead. It may mean the opposite. Second, how paper markets, leverage, and short positions create conditions for violent squeezes. And third, what this means for you, whether you're a beginner just trying to protect your savings or an intermediate investor trying to stay ahead of systemic risk. And let me be clear, this matters now, not next year, not someday, now. Because global debt is exploding, confidence in fiat currencies is thinning, and banks are sitting on risks they don't fully control. When pressure builds long enough, release isn't gentle. It's sudden. Silver has always been a stress metal. It doesn't whisper when something's wrong. It screams. And right now, it's screaming in both directions at once. So if you've felt confused watching silver crash one day and surge the next, if you've wondered why banks keep downplaying metals while quietly hoarding hard assets, or if you just want to understand what's really happening beneath the price chart, you're in the right place. Take a breath, clear the noise. Let's walk through this step by step. Because once you see the full picture, you'll never look at silver, or the financial system, the same way again. Let's start with the uncomfortable reality most people face when it comes to money and markets. They react instead of understand. And silver is one of the most emotionally brutal markets out there. Think about the average person watching silver drop fast. They see red candles. They hear words like crash, manipulation, dead asset. Panic sets in. Maybe they bought higher. Maybe they were told silver was safe. And now it feels like betrayal. So what do? They sell. Or they swear never to touch it again. That reaction isn't stupidity. It's human. We're wired to avoid pain. But financial markets punish emotional decisions ruthlessly. One of the biggest mistakes people make is assuming price equals value. When silver crashes, they assume something is fundamentally broken. But in leveraged markets, especially commodities, price often reflects pressure, not truth. Another common struggle? People don't realize how distorted modern markets are. Silver isn't just bought and sold as physical metal. It's traded through futures, options, ETFs, derivatives, layers upon layers of paper claims. For every ounce of real silver, there are dozens, sometimes hundreds, of paper promises. That creates a dangerous illusion of liquidity. It looks deep, it looks stable, until stress hits. And when stress hits, the system doesn't bend, it snaps. Here's the consequence of ignoring this reality. If you only watch headlines and price charts, you'll always be late. You'll sell when fear peaks. You'll buy when comfort returns. And you'll never understand why markets seem rigged against you. Banks, on the other hand, understand structure. They understand leverage. And they understand timing. While retail investors panic, institutions reposition. They hedge. They squeeze. And sometimes they get trapped by their own arrogance. The reality check is this. Silver is not just an investment. It's a pressure gauge. When it's calm, the system is calm. When it's violent, something underneath is breaking. Ignoring that signal doesn't make it go away. It just leaves you unprepared. To understand what's happening with silver, you need to understand one core concept, the difference between paper silver and physical silver. Paper silver is what trades on exchanges. Futures contracts, ETFs, promises to deliver silver at a later date. These contracts can be created almost endlessly. There's no immediate requirement that physical metal changes hands. Physical silver, on the other hand, is finite. It has to be mined, refined, transported, and stored. It's slow. It's real. And it doesn't multiply just because someone clicks buy. Now here's where things get interesting. When paper silver dominates price discovery, the price can be pushed down through short selling, essentially betting that silver will fall. Banks and large institutions often hold massive short positions. As long as confidence remains, this works. But when demand for physical delivery increases, when people want the actual metal, not just a contract, pressure builds. Suddenly, those paper promises start to matter. A silver crash to $15 can happen when paper selling overwhelms buyers. But if physical demand doesn't disappear, that crash creates a spring-loaded effect. The lower the price, the more attractive physical silver becomes, and the harder it becomes for shorts to maintain control. When price turns green rapidly after a crash, that's often a sign of short covering, sellers rushing to exit positions before losses explode. This is how squeezes start, not with hype, with imbalance. Let's go deeper. Imagine a bank that's short millions of ounces of silver through futures contracts. As long as silver drifts sideways or down, they're comfortable. But when volatility spikes, risk managers step in. If silver crashes hard, some shorts take profit, but others get greedy. They assume control is permanent. That's where danger creeps in. Now physical demand surges. Mints report shortages. Premiums rise even as spot price falls. That divergence is critical. It means price is lying. As silver rebounds sharply, margin requirements increase. Shorts must post more collateral. Some can't. They're forced to buy back contracts, pushing price higher, which forces more buying. That feedback loop is how squeezes accelerate. For you, the insight isn't about trading every swing. It's about understanding signals. Watch volatility. Watch physical premiums. Watch sentiment. Violent moves often precede major trend shifts. Myth 1. Silver is manipulated, so it's pointless. Manipulation exists, but it doesn't eliminate opportunity. It creates it for those who understand structure. Myth 2. If silver crashes, it's dead. Historically, the opposite has often been true. Mistake 1. Over-leveraging. Silver is volatile. Leverage magnifies mistakes. Mistake 2. Short-term obsession. Silver rewards patience, not prediction. The right mindset isn't fear or blind optimism, it's respect for volatility. Step 1. Educate yourself. Understand paper versus physical. Step 2. Decide your role. Are you hedging, speculating, preserving value? Step 3. Avoid leverage unless you truly understand risk. Step 4. Focus on position sizing. Never bet what you can't afford to hold through chaos. Step 5. Stay consistent. Markets test conviction before they reward it. This isn't about timing perfection. It's about survival and alignment. If this breakdown is helping you see markets more clearly, take a second to support the channel. Liking the video tells the algorithm this content matters. Sharing it helps others avoid emotional mistakes. And subscribing means you won't miss deep dives like this when volatility hits. This channel isn't here to sell dreams. It's here to build understanding. Markets are complex, but they're not random. And the more you learn, the less power fear has over you. Silver crashing to $15 isn't the end of the story. It's a chapter, and possibly the turning point. Volatility is the language of stress, and stress reveals truth. The key lesson? Price is noise. Structure is signal. When markets shake confidence, they reward preparation. Whether silver explodes higher tomorrow or grinds longer, understanding what's happening puts you ahead of the crowd. Stay calm, stay curious. And remember this, the most violent moves always come after the most uncomfortable moments.